Welcome back. This is chapter 4 and liquidity. Probably going to be the longest video because, in my opinion, probably one of the most important things you can learn in trading. So liquidity is how the market moves. It goes from liquidity to liquidity. There's several types that we use in our trading. One is session highs and lows. We've got swing highs and lows, and we've got internal liquidity. So the first thing for session highs and lows, you're going to need an indicator. Now, to add an indicator, click on indicators, and in that search box type session. Now there's one here by Lux Algo. It's currently at 6307. If you click on that, that will add it to your chart. Now I'm based in the UK and it's currently British summertime, so I'm going to show you my settings, but obviously you can adjust these based on your time zone. I'm currently UTC +1. So there's 3 sessions that we need to be concerned about: Asia, London, New York. These are the timings to go with each of those sessions. I'm going to leave this on the screen for a second so you can pause it or maybe take a screenshot. And these are the timings that we're going to use for our range high and our range low. So once you've added that indicator, it's going to print these boxes on your charts. So let's just get rid of this. It's going to print these boxes here. So this is currently the London session. If I go back a little bit here, this box here is the Asia session. Now, to mark the highs and the lows of these, I tend to go onto the 15-minute because it's a bit clearer on the 15. So I mark my range lows and highs with a small red line. So that's a range low, it has a red line. That's a range low, it has a red line. This would have had a red line here, but when price moves through it, the red line gets removed. But we do have a range low here, so that's got a red line. There would have been a red line here, but that's obviously price has moved through it. So you get the idea. Red line on the top, red line on the bottom. That is our range liquidity. So when price moves up, as it did here, when it moves up and through that range, that's when we particularly, or we get particularly interested, because potentially we can see what's happened here, and you'll see a reversal in the market. So I'm not going to go into too much detail about that exactly right now and about the trading strategies. This is purely about liquidity. So that's our range high and our range low liquidity. The second type of liquidity that we have are like swing highs and swing lows. So ranges is preferable because it holds quite a lot of authority. Second would be your swing highs and swing lows. For those, I tend to go onto the 15-minute, and in addition to these red lines, you'll see some grey lines. So if we go back to here, so anywhere where price has done something a little bit strange that stands out to you, I'll put a grey line on there. So we've got a grey line because we've made this weird sort of hump. We've got a very long wick there all on its own, so I've got a grey line on there. The red line's obviously there because that's the range high. Here we come down and we made like a little double bump here, so there's a grey line over here. There's another grey line here because we've sort of plateaued there. Price come down, come back up again, come down, come back up again. Here we put in some equal highs and we've got this little pullback here, so there's a grey line above that. There's a grey line above that wick there because we had a really big push up and then a really big push down. We've got some more equal highs there, again an area of interest. So these grey lines are areas of interest, but what they'll start to correlate to is your swing highs and your swing lows. So if you're not sure about a swing high, zoom out on the 1 minute. Anything that's obvious is a swing high or a swing low. So that's clearly a low. That's clearly a high. That's clearly a high. A high, a low, a low, a high, a high, a high, a low. You get the idea. Another lows. Anything that's obvious is a swing high or a swing low. These are important because when these highs or lows are taken, you could potentially expect to see a reversal in the market. So that's our second type of liquidity. So the first was range high, range low. Our second are swing highs and swing lows. You can either mark them up on the 1 minute, or as we have done here, go on to the 15-minute. Anywhere that looks a little bit interesting, we've had a pullback, or we've had some consolidation. Here we've come up, we've come down, we've come up, so it's got a grey line. Whatever way is easiest for you. The third type of liquidity is internal liquidity. Now, in order to see internal liquidity, we've got to zoom in on the market. So internal liquidity is all of these little lows and highs. So exactly the same as what we've just marked up for our swing highs and lows, but we're zooming in now to see it. So here we have a high, here's a low, there's a low, another low, there's a high, there's a low, there's another high. So it's all of your internal structure. So if we start down here, we've got a low that goes to a high, a low goes to a high, a low goes to a high, a low goes to a high, low goes to a high, low, high. And then obviously we come back down the other way. Low, high, low, high, low, high, low, high. That's our internal structure. So depending upon what strategy we're using, we will utilize different types of structure. Typically for the inverse fair value strategy, we use internal structure. So we wait for liquidity to be taken, so swept as it has here, and then move in the opposite direction. For our silver bullet entries, we typically tend to favor the range high and the range low, or the swing high and the swing low. Now, swing highs and swing lows will sometimes fall at the bottom of a range. Sometimes they'll be in the middle of a range. So in order of preference for silver bullet, it's range high or range low to be swept. Second would be swing high or swing low. And then lastly would be internal. The inverse fair value gap, typically you're only utilizing the internal liquidity. That's not always the case, but typically. So that is liquidity. Hopefully that's made sense. Thank you for watching, and the next chapter is going to be covering the inverse fair value gap strategy, one of the two strategies that we trade over at the JC Trading Discord. Thanks for watching.